everyone, we are back today to take a stock of the macro and market events in the month gone by. Equity market fell in April 2022. S&P was down 9%, MSCI EM was down 10%. To that extent, 2% loss in Nifty was rather subdued. Investors still face wide range of uncertainties, ranging from how fast and to what extent the Fed tightens, should the current forward guidance be believed, and then whether Europe sees an energy crisis, how long does the geopolitical stalemate last. There are concerns on how China addresses its COVID situation. Broader equity indices are down, though anything related to commodity outperforms. Government bonds are weak. The slump in demand from Russia and Ukraine is already visible in Asian export data. There is also early evidence of moderation in Asia's export to Europe, a trend that will likely continue as supply-side inflation is adding to the rising cost of livings and can dampen discretionary goods demand in Europe. In China, lockdowns span across 40+ cities. Trucks are stuck, containers are piling up, goods are also slow to arrive in ports for export, threatening to disrupt production network across the region and beyond. It is tricky to estimate the precise cost to the global manufacturing engine, for even the lack of a single component can bring a factory to a halt. China is easing rates and taking steps to implement closed-loop production system and ease logistical bottlenecks. But when set against a backdrop of a strict COVID management policy meeting a transmissible variant, the effectiveness of these measures could be blunted. Now, coming to India, economic activity has improved in March and April, driven primarily by opening up and pent-up demand. And yet, growth projections for FY23 are being lowered to near 7%. It is because of slower global growth and real income shock from higher energy prices, resulting in lower purchasing power. We think goods export growth will moderate. Similar to growth, earnings outlook at the least in the near term looks uncertain. Higher input may be a near-term headwind for corporate margins in what has been otherwise an improving earnings trajectory for 6 consecutive quarters of healthy earnings growth. And if the inflation challenge persists, it may also cause a demand slowdown. This is coming at a time when global central banks have commenced their rate hike cycle, which caps on the near-term gains for equity indices. But beyond the near term, growth prospects for India look encouraging. There are early signs of recovery in the residential real estate sector, a gradual improvement in the capacity utilization levels. We continue to stay positive on capex cycle in India. It may get delayed due to global headwinds, but the need and domestic incentives to undertake capex remains intact. Unlike last decade, corporate and bank balance sheet are healthy to support the investment cycle. Household debt levels are manageable. The government initiative to incentivize manufacturing in India seems to be playing out. China Plus One strategy seems to be playing out for India too, in chemicals, engineering, goods, textiles, garments, and many such spaces. The benefit of reduced corporate tax will help in FDI decision. Last but not the least, even as rate cycle is set to turn, financial condition in India is still benign. To some, equity investors therefore would do well to navigate the near term with caution and patience, even as we stay of the view that in longer term, we are in an earnings expansion cycle. Now, coming to the fixed income, even before geopolitics, central banks were fighting a severe upsurge in inflation that reflected the imprint of pandemic, stressed global supply chains, and tightening labor market conditions. But now, in addition, there is spillover from Russia and Ukraine situation, which has brought about a massive supply shock and which has prompted market to further raise their inflation projections and mark down growth outlook. Central banks have underscored their determination to fight inflation and bring it back down to their target. This is going to be challenging and may require some good luck as well. In India, there is an explicit turn in India's monetary cycle. RBI introduced SDF rate at 3.75%, which will be the new LAF corridor instead of reverse repo, which was at 3.35. It guided towards withdrawal of accommodation, shifted its goalpost back to inflation from growth. Fourth, we saw a considerable upward revision to RBI's inflation projection at 5.7% for FY23 versus 4.5 in Feb policy. But now, given the current food and fuel dynamics, our inflation projection is 100 basis points higher. Finally, there was a clear signal to drain liquidity surplus. To be sure, there will be some effect of passive drain on liquidity on account of likely external account deficit and currency leakage, but some active steps could be in the offing. We expect RBI to deliver its first rate hike in June as inflation backdrop worsens. The trends on the external sector too point out to an incremental worsening in the current account deficit, even as the large reserve buffer provides a reasonable degree of resilience to external shocks. On government account, sharp tax buoyancy helps to tide the current fiscal situation, where we see a nearly 2 trillion of higher subsidy outgo than what was budgeted and lower disinvestment proceeds. Hence, overall, the fiscal path for this year, including the capex agenda and borrowing plans, are likely to stay intact. As macro dynamics change, contrary to the guidance, the exit from policy support measures would have a material impact on market outcomes, especially in a context where market has been repeatedly conditioned to accept the continued policy support. Nowhere is this more apparent than the outcomes in the US Treasury markets over the last 6 months as the US Fed started to flip. Currently in India, we're just where US Fed was a few months ago, and the yields may face an upward pressure across the tenor of the curve, though liquidity reduction adds marginally higher pain to the shorter end. Somewhere through the year, we may enter a situation where there are fewer headwinds to the long end duration, but that phase may still be some time away. Till then, stay cautious on rates. Thank you. Signing off for this month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.